All right, if you're running a business in Nigeria, you already know that profit is king. But here's a thought. What if the profit on your books isn't the same profit the government uses for your taxes? That's where this really crucial concept called adjusted profit comes in. And today we're going to crack that code and figure out exactly what it is and why it matters so much. So let's just start with the big question right here on the slide. Is your book profit your tax profit? The short answer, and the really important one, is a big no. And you know what? Understanding that gap between these two numbers is absolutely critical for any business. Think of it like this. It's pretty simple. On one side, you've got your accounting profit. That's what your income statement says you actually made, right? It's your real-world performance. But then over on the other side, you have your taxable profit. And that's a number that's calculated purely based on the government's own rulebook. They might start in the same place, but believe me, they often end up miles apart. Yeah, you could almost say your business has to speak two different languages. There's the language of accounting. That's for you, your investors, your bank. And then there's the language of tax, which is strictly for the government. To stay compliant, you've got to be a good translator between the two. So, how do we do that translation? Well, as we see here, the bridge between your accounting profit and your taxable profit is this thing called adjusted profit. It's not just a term, it's the actual calculation that takes your book profit and tweaks it, item by item, to line up with tax law and get to that final taxable number. Now, I know what you're thinking. This sounds kind of complicated, but there's a clear blueprint for it. So let's break down the exact formula step by step and see precisely how this bridge gets built. It's not as scary as it sounds. Here it is, the roadmap. It's basically a four-step process. First, you start with the net profit, straight from your accounts. Easy enough. Then, you add back any expenses that the tax law says, nope, not allowed. After that, you subtract any income that isn't taxable. And what do you get at the end? Your adjusted profit. So let's really dig into steps 2 and 3. Okay, let's tackle that second step, adding things back. This is where we look at expenses that were perfectly legitimate for your business. You really spent that money, but the tax authorities basically ignore them. They consider them non-allowable. The logic here is actually pretty straightforward. When you were calculating your net profit, you subtracted these expenses, right? Which, of course, lowered your profit. But since the tax law says, hey, we don't recognize that expense, you have to reverse it. You literally have to add that amount right back in. So what are we talking about here? Well, this slide shows some of the usual suspects. Depreciation is a classic. It's a key accounting concept, but for tax, you use something different called capital allowances. Fines and penalties for, breaking the law, the government is not going to give you a tax break for that. Donations to unapproved bodies, you got to add those back too. And those general just-in-case provisions you might make for bad debt, yeah, that's a no-go for tax purposes. But why? Why are these things disallowed? It all boils down to something called the WREN test. For an expense to be deductible for tax, it has to be wholly, reasonably, exclusively, and necessarily for the purpose of generating income. If it fails that test, you can't deduct it. Simple as that. And here's exactly how it works in the real world. Using our case study, a company called Muhammad Limited, you can see these add-backs in action. That 171,300 naira for depreciation, added back. The 12,000 naira general provision, added back. And that 30,000 naira political donation, you guessed it, it gets added back too. They were all real costs to the business, but for tax purposes, they just didn't pass the test. Okay, so we've covered what gets added back in. Now let's flip the coin and look at the other side of the equation, the items you actually get to deduct from your profit. This is the good part. And the logic here is the exact opposite of what we just talked about. If your book profit includes some income that the tax law says is not taxable, you get to pull it right out. You deduct it. This gets you to a more accurate profit figure, at least in the eyes of the taxman. So what kind of income are we talking about here? Well, the most common ones are profits you might make from selling off big capital assets, like your equipment, your buildings, or even some investments. These types of gains are often treated very differently under tax law, so they get pulled out of this main profit calculation. And we see this play out in our case study. Muhammad Limited made a small profit, 8,690 naira, from selling some of its property, plant, and equipment. Because this kind of gain is treated differently under the law, it gets correctly deducted from the main profit calculation. So we've looked at the additions, we've looked at the deductions, now it's time for the grand finale. Let's bring it all together and see what the final result of our calculation actually is. And here it is, the core formula in all its glory. It's this simple. You start with your net profit. You add back those disallowed expenses, you subtract the non-taxable income, and what's left is your adjusted profit. This is the number that truly matters when you're filing that tax return. And would you look at the staggering differences can make? For Mohammed Limited, their accounting net profit was about 215,000 naira. But after adding back all those expenses and taking out the non-taxable income, their final adjusted profit, the one the tax office actually cares about, jumps all the way up to 466,046 naira. That's more than double their book profit. And this is exactly why getting this calculation right is so incredibly important. You know, this quote from our source material, as a Khan Academy, just sums it up perfectly. There's the story your accounts tell you, and then there's the story you must tell the tax authority, which is computed strictly according to their rules. Two different stories, two different numbers. So what's the bottom line in all this? Well, understanding this journey from your net profit to your adjusted profit isn't just some boring accounting exercise. No way. It is absolutely fundamental for filing your taxes accurately, for making sure you're compliant, and honestly, for truly understanding the financial health of your own business. So, we'll leave you with this question to chew on. If you were to look at your own company's books right now, what hidden adjustments, what disallowed expenses or non-taxable income might be hiding in plain sight, just waiting to completely change your final tax bill this year? Something to think about.